Hi, everybody. This is Jeffrey Dunyan with Safe Option Strategies. I am the owner and founder of Safe Option Strategies. I appreciate you taking some time to join us for this presentation. Wherever in the world you're at, wherever in the country you're at, we welcome you here. I have with me right now Kevin Hurley. Kevin is going to help me do this presentation. Kevin is a registered investment advisor. He trades millions of dollars in the market for other people. And I invite Kevin on to help me with these presentations because Kevin is using the strategies that we teach at Safe Option Strategies to manage very large portfolios for his clients. I'm going to turn some time over to Kevin, let him make a couple of introductions, and then we've got a lot of information to cover. We have a really large class tonight. Our class is just about maxed out on how many people this webinar can hold. And so we're going to try and get through the information as efficiently as possible. Make sure you leave here with a lot of good information that's going to be helpful to you. So Kevin, take it away, and we'll get going with this.
Hey Jeff, I appreciate you having me here today. It's always fun to go over what I see in the market, and obviously more importantly, it's always important to see someone that cares enough to give people a methodology to truly help them make consistent returns under any market condition. As Jeffrey said, I use a lot of strategies he talks about. In fact, I would go so far as to say if more people would use what Safe Option Strategies teaches, he could probably work me out of a job because people wouldn't need what I do to protect their portfolios. Guys, I'm glad to be here with you tonight. Jeffrey, again, thank you for having me, and thank you for caring enough to put something out there to help people during volatile markets like we're in.
Kevin, I appreciate that introduction. Kevin knows that I'm not trying to put him out of business, but I know probably, I feel like I can say this fairly safe. You're taking some time out of your schedule to view this presentation because you're trading your own money. You're wanting to trade your own money. You're looking for ways to get better at what you're doing. You're looking for ways to become more efficient at what you're doing. And that's what we're trying to teach people here. I think what Kevin says is probably accurate. If more people would learn and apply the strategies that we teach at Safe Option Strategies, registered investment advisors like him probably would not be needed. But I don't think that's going to happen anytime soon, that his industry is going to go away. And what a phenomenal thing for him to be able to take these strategies and put them into real life, everyday application for the people that he's trading money for. Folks, we've got a lot to cover, and I want to do my best to keep this presentation to about an hour. I want to be respectful of your time, but I want to give you as much information as possible. Usually it's on the right side of your screen when you start up a presentation. There's a little box that says chat, or there's one that says questions. Use the chat box. If you have questions, type them in there. If the question is very appropriate to what we're talking about right at that time that you type it in, we'll try and make mention of it, and we'll try to address the question right then. If the question is about something that we know we're going to cover a little bit farther down the line in the presentation, we're going to wait. So don't feel like your question is being ignored. And some questions that come in, we know for a fact they're going to be more appropriately addressed in the question and answer period at the end of the presentation. So if you type in a question, I promise we'll answer the question. I promise we'll cover all the information. But we've got a lot to go through, so let's dive right in with that said. Let me tell you the three things that I primarily want to cover in this presentation. I want to talk to you about spotting trend changes. Now, this is as important as ever right now in the markets because so many people on a daily basis make reactionary moves to a 1 or a 2 day move on a stock that they're following. And it doesn't matter if they're trading stocks or options or futures or commodities. They do a reactive move to a 1 or 2 day price fluctuation in the stock or in the markets in general rather than following the trend. And spotting the difference is a very crucial component to long-term successful profitable trading. And so I'm going to talk about how to spot those trends and how to stay accurate with that. I want to talk to you tonight about protecting principal and profit through something called trade adjusting. Now, this is, I think, the appropriate time to say this. We're going to talk about options. It doesn't matter, though, if you're an option trader. If you are, there may be a few of the terms that we use that you're a little bit more familiar with. But if you're not, you're still going to understand conceptually what we're talking about. If some of the terms that we use that involve option trading are foreign to you, don't worry about that. The principle behind what we're teaching is applicable to more than just options. For those people that are brand new to options, I promise you, at Safe Option Strategies, we teach people options from a very introductory, very beginning level, all the way up through some of the most complex advanced option strategies you can imagine. And we do it very thoroughly, and we do it in a very concise order. And so if you're new to options, don't let that concern you or stop you right now. You'll still understand what we're talking about. Okay, so the last thing I want to talk to you about tonight is profiting through trend changes with low risk and zero risk trading. Now, the SEC does not love when I mention zero risk trading, but I'm telling you right now, and I'm going to demonstrate for you and show you tonight, that there are trades you can put together that have a high ability to profit. They have uncapped profit potential in many cases, and you can literally structure trades with very low and in some cases zero risk. And if you don't pay attention to anything else we show you in this presentation, pay close attention when we get to that part at the end. All right. With that said, let's dive in and let's cover this information. Let's talk first about how to spot the trend changes. I want to give the mic back to Kevin. I say that figuratively because Kevin and I are in our offices in different places right now. But I want to give the mic back over to Kevin, and I want him to talk a little bit about what he sees in the markets recently. And Kevin, if you don't mind, a couple of months ago, you shared a story with me about a gentleman who had just made a horrible mistake, and we're not picking on this guy. We're not going to give away his name or embarrass him. He made a horrible reactionary mistake to what happened in the market a couple of days, and it stung him to the tune of some pretty significant money. And Kevin, if you wouldn't mind, you know we talked about this before the presentation, so you know the story I'm talking about. But if you wouldn't mind sharing that, I think that would be a good segue into some of the do's and don'ts of spotting trend changes.
You want me to tell you the story, huh? All right, hey guys.
I want the uncut, uncensored version of this story for these people that are listening to this presentation right now.
Got it. All right, guys. Hey, what I see in the market is a lot of people that really run into a couple problems. One is that they're not doing it as well as they think they should. And that is usually occurring due to 1 or 2 day movements in the stock market. A little bit of volatility that just throws them off their game, primarily because of fear in what we all went through in 2008, kind of followed in 2010 with some flash crashes. There is one day in particular that Jeffrey is circling over that left-hand lower corner in that pink, where I literally talked to a gentleman. I was trying to pick up his business. He says, "You know what, Kevin? I'm done." I said, "What do you mean?" He goes, "Oh, I blew out everything." And I said, "Okay, what does blow out of everything mean?" He goes, "You know what? I shut down every position. Market was down 77 points. I closed everything. I booked a $12,500 loss." And I sat there and said, "But you're doing this in the middle of the day. You know, you just couldn't take it." And he basically said, "Yeah, you know, the methodology, the way he trades, his strategy, his plan, his process, it didn't account or train him to adequately handle a 100-point or a 77-point drop intraday in the market." At the end of the day, unfortunately, the market was back up a little bit. In fact, as we recalculated his positions, he probably could have made about $2,500 that day versus losing $12,500. Where I'm getting at with all this, if you're not where you want to be, if you're not making what you think you can, if you're not able to make money in any market condition, we're glad to have you here tonight because Jeffrey's going to show you what little things are really hurting people big time in today's market. Jeffrey, take it away with the chart.
One of the most common conversations that I have with people when they're looking at safe option strategies, when they're considering getting into an education program like this, one of the most common conversations I have with them is people make reactionary movements on 1 or 2 day movements in the market or in the price of the stock that they're trading. This, if you look right where I put this red arrow on the screen, if you look at the OHLC bar right just to the right of that, that was the day preceding the day that this gentleman Kevin told you about blew out of his positions. The next day, the following day, you can see the market started about where it finished the day before. It moved down a little bit during the day, but by the end of the day, it was up, and it was followed by 2 more days of upward movement in the market, and yet this guy blew out of everything in the early part of the market being open when it was down a little bit. He was reacting to a 1 or 2 day move in the price of the market or the price of the stocks that he was in rather than following trend changes. We are in a market where it is common, and I'm showing you a 3-month chart of the Dow Jones Industrial Average, but this is happening, it's commonplace with the stocks that you trade as well as the markets as a whole. Big moves up followed by big moves down. Reversals from 100, 200 points down on the Dow to being up 100 or 200 points in the next 2 or 3 trading days. Here's a little period of time where 4 bullish days in a row, and then 2 days gave it all back of bearish movement. And then shortly after that, 3 or 4 bullish days in a row got it right back up to where it was at, and 1 or 2 bearish days moved it back down to where it was at. And yet the overall trend right now, currently, the overall trend in the Dow Jones Industrial Average is up, and so is the S&P, and so is the NASDAQ. Look at what happened a couple of weeks ago when we had a very bearish week. That was the red arrow that I put came in ahead of the green one. But that red arrow slanting down a couple of weeks ago, that was 3 out of 5 days that were quite bearish in the market, and yet the market is still bullish. The trend has not changed. And unfortunately, a couple of weeks ago when this was happening, people were panicking. People were saying, you know what, the sky is falling. 2008 is coming back to revisit us. Folks, I'm telling you right now, 2008 is probably coming back around at some point in time, and I think sooner than later. I don't have a crystal ball. I can't predict that with certainty, but I think it's coming sooner than later. It hasn't come yet because the indicators aren't there to suggest a trend change yet instead of a 1 or 2 day move in the market. There are easy ways to spot trend changes versus the 1 or 2 day moves in the market. Let's talk about one of those. What I want to show you before I tell you what to do is what not to do. Now, a couple of months ago, 2-3 months ago, when I was setting up a presentation just like this one you're listening to, I was getting this picture of the stock chart of the Dow Industrial Averages all set up with the right colors and the right indicators listed on there. And as I was setting this up, I pulled this drop-down menu onto the screen, and I noticed it talked about one of the selections or one of the overlays that I could put on was an Ikimoku cloud. And another one was an Ikimoku cloud full because, hey, let's face it, if you could have a full Ikimoku cloud, why in the world would you want to have just a partially full Ikimoku cloud? I don't even know what an Ikimoku cloud is. I have no idea. No offense to Mr. or Mrs. Ikimoku who developed the mathematic formula behind that, but I don't know and I don't care what it is. It's irrelevant. It's white noise. It's background. It's fluff. It's muddying the waters. Parabolic SARs and VWAP and zigzag retrace. It's information overload. I showed you one thing not to do, and that is not to be reactionary to a 1 or a 2 day move in the market. Don't make moves in your portfolio when you see a stock price drop for a day or move up for a day or two. Wait until you get trend changes. But the other thing not to do is don't sit on your hands and do nothing because of information overload. I love to give the mic back to Kevin for just a minute. Kevin, there's a principle, and you know the one I'm talking about because we've discussed this often enough. There is an acronym that was custom made for me. I'm positive that someone invented it for me because I used to overanalyze everything. And you've got to remember this acronym when it comes to spotting the trend changes and the turns versus the 1 or 2 day moves in the market. Kevin, what's my favorite acronym as it relates to this?
That has to be the world famous KISS principle. Keep it simple, stupid.
Love that acronym. KISS. Keep it simple, stupid. I don't want to offend anybody by calling you stupid. I like I told you, I think that acronym was put together for me because I had a tendency to overanalyze things so significantly. Here's how to keep it simple. I've shown you what not to do, a couple of examples of what not to do. Here's what you should do. There are 3 technical indicators that when they cross over at or close to the same time, they give us a 75 to 80% accuracy historically of showing us an actual trend change versus the 1 or 2 or 3 day changes. They are the MACD, the moving average convergence divergence. That's the first one that I circled down at the bottom. When the heavier line on the MACD crosses above the thinner line on the MACD, when the 5-day moving average crosses above the 20-day moving average on the 5 and 20-day exponential moving average, and when the RSI, the relative strength index, crosses above the middle line, the 50 line, those 3 technical indicators coming at or close to the same time have a 75 to 80% accuracy of showing us an actual trend change versus a couple of days of down movement followed by a couple of days of up movement. When they cross over to the downside, they have a tendency, they have a 75 to 80% accuracy to show us a bearish trend. A trend change is defined as more than a couple of percent movement or more than 5 trading days of movement. Now, that's my definition. You're not going to go to Investopedia or Wikipedia or Options Institute or anything like that, or the CBOE. You're not going to go to those places and find. That's my definition. I consider it a trend change when it's more than a couple of percent in a direction, or it's more than 5 trading days in a certain direction. And when you get these crossovers coming at the same time, now that the MACD is oftentimes a leading indicator, as you can see, the MACD came a couple weeks ahead of those other indicators in this case, but when they all 3 gave us the same indication, we got an actual trend change versus a 1 or 2 or 3 day movement in the market. And here's why this is so incredibly significant, folks. If you make adjustments to trades, if you make movements after a couple of days of up movement, but you don't get those indicators, things reverse and they go back the other direction. It happened here, where we got 1 or 2 of our technical indicators, but not 3. If you wait for all 3 to come, you get a more sustained trend change instead of a 1 or 2 day move down in the market. Whoops, I moved my screen thing too far over there. Hang on a second. Sorry about that. There's your trend change instead of your 1 or 2 day movement. That's what I get for moving my cursor too far over on the screen as I'm doing that. And notice there's something else that I want you to notice about this. When we use these technical indicators, we don't catch things at their highest point, and we don't necessarily catch things at their lowest point. We catch 75 to 80% of the movement. We catch it from the time of the technicals to the time of the next technical crossovers. If 75 to 80% of the time you could capture 75 to 80% of the movement and all you were doing was buying and selling the stock, how much better would your trading be? How much better off would you be? You need to make moves in the market based on the trend changes, not on 1 or 2 day moves in the market, and you need to make those moves when the time comes instead of getting froze up with the paralysis by analysis and not making any move at all. Kevin, anything additional you want to comment on here before we go to the next category that we wanted to cover?
You know, I'm going to hold off.
Okay, all right, let's keep moving along. Now, I told you earlier, don't worry about whether or not you're new to option trading. If you're new to option trading, we have classes that teach everything you need to know about options. I want to show you how to protect and how to protect your profit, how to protect your principal through something called trade adjusting. Kevin and I have had this conversation a number of times. I have this conversation with dozens of people every week, with hundreds, maybe it's up to thousands of people over the years that Safe Option Strategies has been in business. I've had a similar conversation. Jeffrey, my trades, I'm accurate. 75 or 80% of the time. 3 out of every 4 trades I place, 5 out of 6 trades, 9 out of 10, 19 out of 20 trades that I place, I'm right. The stock does what I think it ought to do. And whether it's an option-only trade, whether it's a stock trade, whether it's some kind of combination, a spread trade of some sort, it does what I need it to do. And then that 1 in 4, 1 in 5, 1 in 10 that goes against me, it wipes me out. It takes away all my profits. It causes me to be negative overall in my portfolio. Kevin is going to demonstrate for you. I'm going to give the mic back to Kevin. I want Kevin to demonstrate for you how and why this happens to people, because folks, probably 85 or 90% of the people I talk to on a day in and day out basis have experienced this to some greater or lesser degree. They've experienced this. They know what's going on, but that 1 in 20 or 1 in 10 or 1 in 5 trades crushes them. Kevin, show us why that happens.
Hey, I'm just going to tell you, the reason why is because people are not asking the right questions. In fact, I think one of the biggest farces when you hear some money manager tell you the percentage of trades he's profitable on. Let me show you how in real life you can be profitable 75% of the time and still be losing money. Let's say we do a spread trade, a bullish trade. We're just following the market trend that we've had for the last 3 years. It's a 4-day trade. We book a 20% return. $5,000 makes us an extra $1,000. We use that compounding interest theory. We're going to take all that into our next trade so we can make some real money. Second trade, it's a 2-week trade. We net a 23% return. On $6,000, that's a $1,308 profit. We're still going to use that compounding interest theory. We're going to make even more with it. Third week, it's a 1-week trade. We net a quick 18% return. We now are sitting at what I'm going to deem a nice chunk of change. I'm going to say, anyone that's giving me $8,600, I take it in a heartbeat. We place our 4th trade. Maybe we were foolish to place a stop loss on the trade. Maybe we just got scared. We closed out the trade. Here we just had 3 profitable trades, 1 bad trade, a 75% success ratio in trading, yet we take a $4,354 loss. 3 out of 4 trades work. We now literally have a loss of $646 in the account, or a 13% loss overall in our portfolio. Jeffrey, show us what this looks like on a chart.
Yeah, in case you're thinking that this might just be a hypothetical thing, this is what happens. Here's a stock chart of Caterpillar, 3-month chart of Caterpillar. Whether you've ever traded around Caterpillar with stock or with options, whatever you've done, you know the company. You're familiar with who they are. Caterpillar had a nice bullish trend for a couple of months. And you place a trade following this bullish trend, and it's a good trade, and it nets you a good profit, and so you place another trade, and you continue to follow this trend, and you place another trade, and you continue to follow this trend. And even after a little bit of a bearish move right here, you get a bullish move up the next day, and look at how many times that happened previous. So no one is faulting you, and no one is saying it's the wrong thing to do to add that 4th bullish trade in a row. And when I say bullish trade, it can be an option trade, it can be a stock trade, it can be some type of combination, some type of spread trade. Again, focus on the principle of what we're talking about, whether or not you understand the options. No one would fault you for placing another bullish trade, because that's what the trend is giving you. And then all of a sudden, without warning, we get almost a 10% move down in the price of the stock in one single day, accompanied by heavy volume. And that's that 4th trade out of 4 that costs you not only your principal, or excuse me, not only your profit is eaten up, but some of your principal. This is what happens to people over and over and over again. They're doing what they should do. They're following the trend, and all of a sudden, those crossovers come, and boom. Remember I said those technical crossovers have a 75 to 80% accuracy of predicting a trend change? Sometimes when they happen, sometimes when they come, the damage is done, because here were the indicators, and the stock price was down this far before the day was over, and only finished a little bit up off of its daily lows. This happens to people all the time. I'm going to give it back to Kevin. I want Kevin to show us the difference with being able to adjust. Now, let me say this before he takes this away. Adjusting trades is simply understanding and knowing how to turn a trade to match the direction that the stock gives you when the stock price turns on you. That's what adjusting is. Now, there's a lot to adjusting, but in its simplest definition and simplest concept, you're setting up a trade to take advantage of one trend. Something happens that you're not expecting. You're now adjusting the trade to follow the new trend. Kevin, show us the difference when people know how to adjust a trade.
Boy, this is going to make a world of difference in a portfolio. We're going to do the same 4 trades, same stock, same version we did it on last time. Let's do trade number 1. It's a 4-day trade, 20% return. We still make that same $1,000. We're going to use that same compounding interest theory. Off we go to the next one. Next trade, though, notice it's a little bit different. In fact, we're setting up our trades now for nothing more than preparing for the worst case scenario versus the best case scenario.
Kevin, can I interrupt you? Can I interrupt you and jump in here?
Yeah, go ahead.
I'm sorry. There's something else that I feel like needs to be added right here, and I apologize for interrupting Kevin like this, but this is important for you to pay attention to, very close attention to. Notice Kevin said the same 4 trades, but on the first set of 4 trades we showed you, that return was 23% on a 2-week trade. Let me add something to this concept of adjusting trades. I have people tell me from time to time, Jeffrey, I've seen other education companies that teach you how to adjust trades, or there's other education companies that teach strategies similar to what you teach. Why are you guys different? What's the difference in what you do? This is the difference. This is what I believe is significantly different about safe option strategies. Knowing how to adjust a trade is different than setting up a trade so that it can be adjusted. Both things are needed. Owning a set of tools to fix a vehicle and leaving the house without those tools is worthless to you. You might own $1,000 worth of tools that will help you fix your car if it breaks down, but if they're at home and you're on a road trip, I'm sorry, I don't know a different way to say it, you're screwed. You're in trouble. If you know how to adjust a trade, but you don't set up a trade that can be adjusted, it's like leaving that toolbox at home when you go out on that road trip. What I believe is the biggest difference between safe option strategies and some of our competitors, I'm not going to name them by name. I'm not here to badmouth our competitors. What I believe is the biggest difference in what we teach is that we take a tremendous amount of time to teach you how to structure a trade that can be adjusted. And sometimes that means you're going to get a little bit smaller return on that trade, but you're going to trade off that smaller return for the ability to adjust it. So that's an important concept to know, and I might elaborate on that a little bit later. But Kevin, I apologize for interrupting. I'm going to give it back to you.
Not a worry. Very important to know. All right, back to the second trade. Set up a little bit differently. Instead of being in it for a better return for a long period of time, we're in it for only 1 week, 15% return. We're not going to book quite as much, but we're still making a profit. Third trade is an 8-day trade, another 15% return. $600 books $1,035 of profit. Don't have quite as much, but here's the big difference. This makes a significant difference in your portfolio. The stock moves bearish, but instead of being foolish enough to set a stop loss to get yourself out of the trade early, you adjust it. Now you don't make anything, maybe even lose commissions, maybe you even lose $100 on it. How does that overall affect your portfolio? You still have 3 or 4 out of trades that worked, 1 that didn't, but now your portfolio is at $7,935 or has a 59% gain in it. That's a 70% difference from that other person that took a loss of 13%. This is what makes a difference in consistent returns in your portfolio. This is how you protect yourself from not just getting yourself wiped out on a 1 or 2 day trade. I can't think of a better way to trade. Jeffrey, show us again on that chart.
I'm bringing up the same chart, and this again, I just want to illustrate again because I think it's worth driving this point home. You're setting up these trades now following the same trend. We're not talking about doing anything different as far as the trend is concerned. We're following the same trend. we're making a bullish trade after a bullish trade. And then the same thing works in reverse. You could be making a bearish trade and a bearish trade and a bearish trade, and the market suddenly go bullish on you, and the same principle applies. The difference with each one of these trades is that we're setting them up a little bit different so that we can adjust them if necessary. And then when this fourth trade goes on, and suddenly the market is giving you this, suddenly the stock you're trading is giving you this, instead of having to be hammered with that loss that wipes out your profit and maybe some of your principal, we adjust the trade to follow the new trend. See how it's important to know when the trend is changing instead of just a 1 or 2 day movement down, and knowing how to adjust the trade? This is the main focus of what we do at Safe Option Strategies, is teach people how to adjust trades. Now, I told you we would also show you the last principle or concept that we wanted to show you in this presentation is how to set up a low, or maybe in some cases a zero risk trade. Now, we've been talking about option trades, spread trades. To some of you, that's common knowledge. You understand it, you know it. Hopefully this idea of adjusting is a little bit new to you, or maybe you've been introduced to adjusting, but the idea of setting up the trade correctly so it can be adjusted is something you need to add to what you're doing. Some of you are stock owners. Some of you are futures and commodity traders, Forex traders. What we're going to show you now is how to set up a very low risk or zero risk trade using stocks and options in conjunction with each other. Again, if not all of it makes sense to you, if not all of the terms that we use make sense, follow the math on these trades in terms of your potential profit, your potential loss. That's what you need to focus on if some of the terminology is a little bit foreign to you. I'm going to make Kevin the bad guy in this scenario. Kevin is going to show you the wrong way to set up this type of trade. It's a collar trade that we're talking about. I'm going to show you the right way to set it up when he's done. So Kevin gets to be the bad guy. I get to ride in on the white horse with, you know, the knight in shining armor. I'm going to show you the right way to do it.
All right. Hey, if you don't mind, I'm actually going to tell you all, I get to talk to people from Goldman Sachs, from Prudential, from TD Ameritrade. I'm going to use one of their examples on how poorly a trade can be set up. Kevin, you're a money manager. You should know you need to protect every penny of the stock. If we bought Best Buy at this time, it would be literally a cost of $28.84. Kevin, every penny's at risk. So what I do, I buy protection. I buy an insurance. I buy a long put, the right to sell a stock at a certain price for a certain period of time. That insurance costs 72 cents. And I kind of laughed and chuckled because he's protecting the stock at $28, which means he's got 84 cents of risk in that stock after he's just pounded to me in my head, every penny's at risk in the stock, so I'm going to not protect every penny. Makes a whole lot of sense to me. I don't know about the rest of you. Kevin, to help pay for my insurance, I'm going to cap myself. I'm going to cap myself at $29 a share. I'm going to sell a covered call, or I'm obligated to sell my stock at $29. Someone's going to pay me 77 cents. Yes, that does completely pay for that insurance that, by the way, didn't cover every penny of the stock. And lo and behold, his overall risk in the trade is a whopping 79 cents. I'm going to admit 79 cents is a lot better than $28.84. But his maximum profit, the way he set this up, is only 21 cents a share. I don't know about you guys, but to have 4 risks for 1 reward, to make such a piddly amount of money on a collar trade, man, this just doesn't do it for me. Jeffrey, please show us a proper way to set up a collar trade.
All right, here I come, knight in shining armor. I'm going to show you the correct way to do it. I'm going to save everybody. I'm going to save your trades. I'm going to save your portfolios. All right. I hope I'm not overstating this. I hope you're not getting frustrated that I'm overstating it. Follow the math on this, even if you don't understand how all of these options work. The math is what's important on this, and we can explain and teach anybody how the options work. Let's say we're getting into Best Buy for that same $28.84, and you guys are probably looking at this and noticing that this is a month and a half old. This is an old option chain that we're using. The reason I didn't update this for the presentation that we're doing today is we actually had all of our students that wanted to, whether they were doing it with a virtual account or whether they were doing it with real money, we had all of our students put this trade on a couple months ago, and I'm going to tell you in a minute what actually happened with this. We bought the stock for $28.84. We went out and paid a little bit more money per share for the right to sell our stock at $28 a share. A long put option, for those of you that are newer to options, a long put option works very, very similar to an insurance policy. It is like buying insurance to go with your stock. If we had 1,000 shares of Best Buy at $28.84, that would be a almost $29,000 investment. For another dollar and some change per share, we can have an insurance policy that allows us to sell all of those shares at $28 a share. That's what that long put does. In addition to that long put, we're going clear out to January 2016 and selling a call on this. Now, that's a covered call for those of you that understand options a little bit. For those of you newer to it, and I'm saying this because I know we have a really big group. In fact, I think we're maxed out on our attendees tonight. The covered call is you're taking money from someone, and in exchange for that money you're taking from them, they have the right to buy your stock away from you, in this case at $33 a share. So if the stock price, if after getting into this position, the stock price jumped way up to $33 a share or more, someone has the right to buy your stock from you at $33 a share, but they paid you $2.96 per share for the right to do that. Now, because we took in so much money on that short call and we didn't spend nearly as much of it on those long puts on the insurance policy, the right way to set this trade up is we're going to double up on the number of long put contracts. So if we owned 1,000 shares of Best Buy, instead of 10 contracts covering that 1,000 shares, we're going to get 20 contracts to cover that 1,000 shares. That means half of our long put contracts are protecting our stock. That's our insurance policy. It's like being double insured. The other insurance policy, the other half of those long puts, are going to make us profit if the stock goes down. So here's the difference between what Kevin showed you and what I'm showing you. Follow the math on this. $28.84 per share for the price of the stock. Long puts at $1.09 per share, but we're getting twice as many of them. So relative to the number of shares of stock that we have, it's times 2. It's $2.18 a share. We're going to get paid, someone's giving money back to us, $2.96 per share credit for that 33 strike price short call. And what that gives us is an overall average cost per share. That's what cost basis is your average cost per share of $28.06. And we have the right to sell our stock until the expiration of those long put contracts. We have the right to sell our stock for $28 a share. Now, I want to throw a question out to you. We've got a big group of people. I know a handful of you already know the answer to this. Some of you might guess on this. I'm not going to call anybody out by name and embarrass anybody. Who can tell me, through typing in that chat section, who can tell me what is the most amount of money per share that we could lose on this position if after setting this up, Best Buy dropped from $28.84 a share down to $20 a share, which, by the way, only a few months ago, Best Buy was trading at $20 a share. It's not unreasonable to think that it could go back to $20 a share on a bad earnings report, on some bad retail sales numbers, on the overall market turning and going down. If you don't think Best Buy could drop back down to $20 a share almost in a blink, you've not traded the markets long enough to experience that. It happens to everybody. Okay, several answers have come in. In fact, a lot of answers have come in. I don't see any of these answers that are wrong, but I do see a couple of them typed in with a question mark behind them, people that are a little unsure. But every one of you are right. 6 cents per share is the most amount of money we could lose on this trade between the time we get into it and the time those options expire. If you put 20, now you don't have to buy 1,000 shares. I'm using 1,000 because it's really easy math to multiply in those even increments. You could do this with 100 shares. You could do this with 200 shares, 300 shares. It doesn't have to be 1,000 shares. If you had 1,000 shares of Best Buy and literally almost $29,000 worth of stock ownership in this company, how are you going to sleep better at night? with all $29,000 at risk if something catastrophic happened to the price of Best Buy stock, or with 6 cents per share? On 1,000 shares, folks, that's only $60. Which is going to allow you to sleep better at night? 6 cents of risk, $28 of risk, $29 of risk. And if you're worried about that short call being out there at $33 a share, what would happen if after you set up this trade, Best Buy took off to the upside and in a blink it was at $35 or $36 or $37 a share, but you had to sell your shares at $33? If I'm doing my math, the difference between $28.06, which is our average cost per share, and $33 a share, which is where we'd have to sell our shares at, the difference in that is $4.94 a share, and I think that comes out to just a fraction below 18%. If having to get out of a position, if being forced out of a position for only an 18% profit would bother you, do yourself and everyone that counts on you for money a favor and get the crap out of the market right now today, and don't ever spend your money in the market again. I'm sorry for being so bold and passionate about that, but if you're upset or bothered by an 18% profit on a position that had damn near no risk to it, you should not be trading money in the market. You are in for heartache over and over and over again. And I am passionate about that, folks, because I hate seeing people lose money. It tears me up to see people take their hard-earned living and squander it on trades that they don't have to be in when there's a safer way to do it. I got to get off that soapbox because I probably have already gone off on that a little too strongly, but my apologies. I don't mean to offend anybody. I want to see people succeed in what they're doing. Let's throw you a twist. Let's throw you a big fat curveball. And what if we did this exact same trade that I just showed you with a little twist? Instead of twice as many long puts, let's do 1.5 times as many long puts. We still have the right number to protect our stock with an insurance policy, and then we have half again that number that could make us profit if Best Buy went to the downside. Remember, those extra long puts that aren't needed to protect the position, if Best Buy dropped, those are making you profit. You're not just protected in this, you're profiting in this. And because we're spending less money by only getting 1.5 times the number of contracts we need, let's spend the remainder on some long call contracts. Let's go out, if we have 1,000 shares, let's go out and get 5 long call contracts. Because now, if Best Buy is taking off and going up past $33 a share, and you have to sell your shares at $33, and you're saying, oh, woe is me, I'm only making 18% on that. Well, guess what? In addition to that 18%, you have long calls now that will have close to tripled in profit. If you're getting called out on that stock at $33 a share, it's because the stock is worth more than $33 a share. And that means your long calls are worth 3 times what you paid for them. Now your profit is uncapped. It's unlimited until the expiration of those options. Do the cost basis on this again. $28.84 for stock. Long puts at 1.5 times the number we need relative to our stock position is $1.64 average per share. And long calls at half as many as would be equal or as our relative to our stock position would be an average of 60 cents per share, and the same credit on the short calls, and that means that our cost basis is $28.12 per share, and for 12 cents per share total risk, we now have unlimited profit potential to the upside. And we can still profit to the downside. When's the last time you bought a stock and made money when it went down? Now, this is way different than shorting a stock. Shorting a stock has a lot of risk in it. It has unlimited risk in it. You can lose more than what you stand to make if you short a stock. This is way, way different than shorting a stock. This is buying the stock. This is owning the stock and actually profiting from a move down and uncapping your profit potential on the way up with almost no risk. Folks, and I could show you trade after trade after trade after trade where you could get those numbers, a little bit more credit on that short call, a little bit less money on long puts and long calls. You can actually get this to zero risk. You can get your cost basis lower than the strike price of your long puts and have zero risk in the trade. And the reason I did not get some updated, up-to-the-minute prices on Best Buy is because the students at Safe Option Strategies put on a trade like this a couple of months ago, got into Best Buy, and Best Buy got up to $33 a share not too long ago. Now, it's pulled back in the last couple of weeks, but a couple of weeks ago, Best Buy was up at that $33 a share. And you know what our students were doing? They were getting out of a 1 to 1.5 month trade, depending on when they got into it. They were getting out of the trade with a 30 to 35% profit on a trade that they had 12 cents or less per share of risk in. If that's not doing anything for you, if that's not intriguing to you, you're doing the wrong thing with your money. Go buy real estate. All right, last thing I want to show you, and we have just the right amount of time to go through this so that we can answer your questions and still keep this presentation really close to an hour. And folks, there's a number of questions that come in. I've read each one of these questions as they've come in. I promise they are more appropriate to answer in the question and answer period afterwards. So I'm not ignoring your question, because one gentleman has typed in his question like 3 times. It is something we are going to talk about in the question and answer period. So please don't think I'm ignoring your question. All right. So that you don't think this is all theory, at the end of last year, a student of mine who's been in our program at Safe Option Strategies for about 5 years now, he called me up just after the end of the year last year and said, Jeffrey, can I tell you what I did with your exploding collar trade over the last couple of years? And I said, please share with me. This is a real live trade that one of our students did. This is a stock of First Solar. Back in May, and by the way, this chart that you're looking at covers a span of 30 months. In May of 2011, this gentleman had 500 shares of First Solar stock. Excuse me, we were just talking about Best Buy. 500 shares of First Solar stock that were worth $120 a share. Look all the way over to the right side of your screen where the price of that stock is. They were worth $120 a share going into an earnings report in May of 2011. He had a $60,000 investment. Now, not all of that was money out of his pocket. Some of that was profit. A number of those 500 shares he had bought for down around $75, $80 a share. So he had some profit and some principal that he was protecting. And now, before I tell you what he did, let me show you what would have happened if he would have just hung on and suffered through that trade. Look right in the middle in the bottom of your screen. This stock got down to less than $10 a share at one time. At the end of last year, it was still only worth $60 a share, and he would have been down 50% in this position if he would have just sat there and held it. Most people would have sold out somewhere in September, October, November of 2011, or worst case scenario, they would have got it out. They would have got out in the first quarter of 2012, but they would have done so having lost money in the trade. Doing exactly what I just showed you with Best Buy. More long puts than what were needed to insure or to cover those shares of stock. A longer term short call option to pay for all of those long puts. And on this big drop down, and more importantly, on the technical indicators, the first time during this period of time that he got the KISS, keep it simple, stupid, MACD, 5 and 20-day moving average, RSI, all crossing over at the same time. The first time he got those, he took all of that money from those long puts. And this is the one part I didn't show you with Best Buy. Every dime that those long puts were worth, he invested into more stock ownership at a much lower price than what it had been trading at previously. So relative to his overall portfolio, he was not investing more money in this position. He was just adding shares on the backs of long put money that was somebody else's loss, quite honestly. He added 1,000 shares to those original 500 shares that he started out with. 1,000 shares. And it didn't cost him anything to do it relative to his portfolio. It was profit from those long puts. He repeated the same thing right here. And on the technical crossovers, again, back to the upside, keep it simple. He added 4,000 more shares to his position. Now, there were a couple of, I like to refer to these as head fakes. There were a couple of times where he got these little fakes. He had long puts in place, or he had these long calls, and the stock sort of did a reversal after a short period of time. There were a couple of times when he lost $300, $400, $500 on some options. One time he lost over $1,000 on some of those options. Let me tell you why he absolutely did not care, because at the end of last year, he had over 6,000 shares of First Solar. He had not increased his cost basis per share beyond that $60,000 investment that he had. He was $300,000 in a 30-month period of time, 500% growth. Now, there were times when he could have simply got out of the trade. Right here, he could have got out of the trade. He had all of his shares protected with half of his long puts. The other long puts were profit. He could have bailed out at that time. There would have been nothing wrong with that, and he would have been profitable in the trade. He chose to stay in it for the long haul. Still has First Solar shares today. And folks, 30 months, $300,000 profit, 500% growth, unreal, unbelievable. And yet it happened using the methodologies that we're teaching people. And I've got other students who have had similar things happen. And I've got lots of students that have profited on stocks that are down from where they were at a year ago, down from where they were at 6 months ago, 2 years ago. At Safe Option Strategies, we sell an education program. Bear with me and let me tell you really quickly what's included in the education program, and let me tell you the promotional offer that we're giving people right now if they're interested in the presentation, and then I'm going to jump into these questions. We sell 2 different courses at Safe Option Strategies. One of them is the Ultimate Collar Trade course. Everything I just showed you and Kevin just showed you with Best Buy and with First Solar, every nuance, every detail you need on when to adjust, when the right time is to add long puts, what strike price you should add long puts, when to get out of those long puts, when to roll them, when to roll short calls, everything you need to know in detail and in logical order, building it up from someone who's brand new to options all the way through advanced adjustments on this, we teach in this Ultimate Collar Trade course so that you can do exactly what this student did with First Solar. You may not get exactly the same results, but you can do the same kind of trade. We do this through a series of 16 online classes. Every one of these classes is pre-recorded, and a couple of times, most weeks, I say most weeks because once in a while I want to go on vacation, other people at the company go on vacation. Not every single week of the year do we teach live classes, but on average, a couple of times each week, we also offer these classes live so you can watch them at your own pace, pre-recorded, anytime you want, as often as you want, or you can sign up and get into the live classes and have the live interaction with an instructor, kind of a similar format to what we're doing today. You can go through as fast or as slow as you want, but it teaches you everything very thoroughly, and we update the classes on a regular basis so the information is new and fresh. We also send out a monthly newsletter. We have a blog site, and we have weekly chat sessions. And the purpose of this newsletter, blog site, and chat sessions is to constantly update you on the trades that we are doing as a company. This newsletter that we send out each month highlights a company that we are going to open a collar trade on. And you have the ability to get into that trade the same time we do, because we'll send that newsletter out on a Sunday or a Monday, and we will not get into the trade until after every one of our students has had a chance to look at what we're going to do. Anybody can say, look at how smart I was. I got into Apple when it was $25 a share. Now it's $700 a share. This is before the 7-for-1 split, obviously. But anybody can say that, and most of the time it's BS. If someone says, you know what, tomorrow at the open of the market, I'm going to get into some shares of Apple, and if you want to follow what I'm doing, you can get into those shares at the same time I do, and that way I can't BS you about my results. You're going to know what my results are, and you're going to know that I'm being truthful about them. That's the reason for that newsletter. The blog site, the chat sessions give you up-to-the-minute updates on anything we're going to do to make an adjustment to those trades. It's a fantastic way to stay in touch with what we've got going on. This course normally retails full price for $2,500. You're not going to have to pay that price right now. I'll tell you in a minute what we're going to do. We have a second course that we offer at Safe Option Strategies that is for those people who do not want to own stock. Maybe your portfolio only has $5,000 or $6,000 in it. It's not realistic for you to own a couple hundred shares of a stock. But you like the idea of knowing how to put on the right kind of spread trade. Remember the example I gave about the car and leaving with the tools or leaving without the tools? You need to know how to set up the trade correctly so it can be adjusted, and then you need to know what that adjustment strategy is. But you want to do it with options only so you can leverage a little bit more. You don't have to put as much money in trades. Through this spread trading course, we do 22. Actually, that just earlier today, I'm not making this up, just earlier today we added a class. So we're now at 23 online classes for the spread trading course. Everything you need to know from the very beginning basics of options all the way through complex spread strategies and the adjustments that go through those strategies. There's over 30 different spread trade strategies and variations of those strategies that we teach you very, very thoroughly in this education. And most importantly, we teach you how to adjust those trades and when and why and where to adjust them. With this course, we have a weekly newsletter. Now, this weekly newsletter could possibly be one of the most powerful pieces of this entire education program. With this newsletter, you get a new spread trade. That spread trade is an option-only trade that doesn't involve the stock ownership. Every week, we send you out a new spread trade. But we don't just send out the trade. We tell you, here's the reason we're picking this company to do the trade with. Here's the reason we're picking this strategy. What are the technical indicators that we're seeing that lead us to believe that it's going to go bullish or bearish or stay somewhat flat or hold in this level of resistance or support? We tell you exactly why we're picking this particular trade at this particular time. We tell you what our expectation for the stock is and what our target exit strategy is. Here's where we're going to be satisfied with our profit and control our greed and get out of the trade if we get it. Then, most importantly, we tell you very specifically, here is how and when we are going to adjust this trade if we're wrong. Because, folks, no matter how good you are in the markets, if you're trading Forex, if you're trading options, if you're trading commodities, futures, U.S. equities, it doesn't matter what method of trading you're using. Every time you put money on a trade, it is a guess. You may have a lot of information to back up why you're doing what you're doing, but it is still an educated guess. And every position you go into, no matter what you're trading, if you don't have a backup strategy, and I hope it's a better backup strategy than a stop loss, because that's just a guaranteed loss. If you don't have a backup strategy, an adjustment strategy, just say, if I'm wrong, because I know I could be wrong, here's what I'm going to do. You're going to be one of those conversations we have down the road. Jeffrey, Kevin, 8 out of 10 trades I place are making me profit. It's that 1 or 2 in 10 that are crushing me. They're absolutely beating me up in the market. My husband or my wife doesn't want me trading anymore. My partner doesn't want me trading anymore because I'm doing good on 6 out of 7 trades, but 1 in 7 is killing me. You're going to be one of those conversations down the road if you don't figure out how to adjust trades. In this newsletter trade, we have a proven track record of success. We lose money on trades once in a while, but our overall portfolio is up. We're up over 21% so far this year. We had a 45% net return on our portfolio last year. And just like with that collar trade newsletter, every one of these trades you see in advance. We don't place a trade and then tell you the next day what we got into or what we adjusted or what we got out of. We tell you before we get into the trade. We tell you before we make the adjustment. We tell you before we close the trade. So that if your desire is to follow along with us to the letter, you can do it and you can call us on it. You can say, hey, there's no way you got out of that trade with a profit because I got in at the same time as you and I'm not profitable. We can't pull the wool over your eyes, folks, the way we do this. That's why it's such a valuable piece of this education program. We also have the live weekly chat sessions with this program. We also sell this program at full retail for $2,500. Anytime someone wants to buy both courses, and I recommend it, but you don't have to do it that way. You can go through one course or the other. But anytime someone purchases both courses, we automatically knock $1,000 off the full cost to give you a discount. Now, for those of you listening to this presentation this week, We know we're in the middle dog days of summer. We know some of you have been beat up in the market or in your trading, even though it's a bullish market. We know that some of you have experienced firsthand what we're talking about with that 1 in 7 or 1 in 10 or 1 in 20 trades that are just beating you up. If you will email or call us, and that is the only way we are going to hold this discount in place for you. An email or a phone call to us does not obligate you to buy the education, but if you will call us or if you will email us today and say, Jeffrey, will you please hold that discount? I haven't told you what the discount is. Here, I'm telling you what to do. For this week, I got ahead of myself. I'm sorry. For this week, we will take another $1,000, 25% additional discount off of the full combined course. So instead of $4,000 for the full course, you can get it for $3,000. If you absolutely unequivocally know that you only want the Ultimate Caller course or you only want the Spread Trade course, we'll do either one of them for an additional $500 off, so that they would be $2,000. So the offer that we're running right now, the special promotion that we're running, $3,000 for the entire education, $2,000 for either the Spread Trade course or the Ultimate Caller Trade course if you know for a fact you only want to do one or the other. As long as you will email us or call us. We have people from different countries that are on. Some of you, when you get off this program, it's the middle of the night where you at. Some of you, it's the morning hours. Some of you, it's late night on the East Coast or whatever. Within 24 hours after you're watching the presentation, because I know we have a bunch of time zones around the world, if you'll email or call and leave us a message, if we don't answer, within 24 hours after seeing this presentation, we will hold the discount in place for you so that you have the remainder of this week and through the weekend to get questions answered through emails, to call us and ask questions if you want to do some research on us as a company. We have nothing to hide, folks. We have absolutely nothing to hide. You can research us. You can call us and ask questions. If myself or one of my employees cannot answer your questions to your complete satisfaction, I don't want you buying our education program. If I can't satisfy you that you're making a good move, I don't want you in the program. Kevin, I have about 6 questions that I want to read through to see if some of them are repeats of the same question. While I'm doing that, do you have anything that you want to add to this? We're right at an hour right now, so we're into the question and answer period. We'll try and quickly but efficiently answer all your questions. Anything you want to add while I read through these?
Hey, I was just going to say that literally, Jeff, I appreciate you showing us what people could be doing in the market. I wish more people were doing that in the market. It'd make my job easier. I think it would help people with their overall portfolios. I'm a firm believer. We can't afford to have our portfolios take any big hits while we're building it for retirement. And if we're in retirement, we definitely can't take a hit to our portfolio because that's what we're going to live off of. I do appreciate you having me here tonight, and let's get those questions answered.
Okay, I've got about 6 or 7 questions. It looks like some more people are typing, so I know I've got some more questions coming in. I'm glad I read quickly just at a glance through these. Honestly, 3 of these questions were just a slightly different way of asking the same question. It's a very good, very insightful question. The question is basically, I'm summarizing, but the question is, if your long puts are expiring in the month of August, but the stock price is still moving down, what do you do? And that's the gist of the question. It was asked in a couple different ways, but I think I covered everybody's question with that summary. It's a very good question. It's a very insightful question. One of the things we teach you in the education is exactly what to do regardless of what the stock is doing. What do I do if the stock is still moving down? What do I do if it flattens out a little bit and it's stagnant? What do I do if I place this trade and it takes off to the upside? The easiest answer to give you is that we teach you very thoroughly what to do in that case. But let me give you a more detailed answer than that. A more thorough answer than that is for me to say, if the stock is moving down, let's use the Best Buy example. The stock has gone from $28 down to $20 a share now, but we don't know if it's going to stay at 20 or if it's going to continue down. You've already protected your position from 28 down to 20, so it's okay to go purchase another long put option at a $20 strike price. You don't have to still be up at 28. You've already protected from 28 down to 20. You may roll your short call down in strike price to take in a bigger credit to help pay for those new long puts. Or if you had a ratio of more long put contracts than what were needed to cover that stock, there is some additional profit there to buy more long puts. In the example I gave you from one of my students on the first solar trade, the second time he added long puts to that position, in fact, the second, third, and fourth time he added long puts, he was using some profit from the excess long puts that he needed to cover his position. So one set of his long puts had already covered the downward movement. The additional long puts helped to pay for new long puts without him having to come up with money from somewhere else that would have increased his cost basis. And so it would be hard for me to go into more detail than that, but that's essentially what he did. And hopefully that's a good answer to your question. Now, there's a question that came in. There's a question that came in about the Greeks. Let me talk to you about the Greeks really quickly. And folks, keep typing in questions. We'll stay. Kevin, can you stay longer to answer questions to help these people out? I can stay as long as you need me to answer questions. I can't necessarily commit Kevin to that.
Here.
Okay.
Let's get them all answered.
Keep typing in your questions, folks. We'll get to all of them, and from here on out, I'm going to go in order. I took a couple of those questions that were the same questions out of order, but several more questions have come in. We'll answer these in order. As it refers to the Greeks, for those of you that are new to options, you're not going to know what the Greeks are, and I could make a really bad joke about it's all Greek to me, but I'll refrain. I already did. Bad joke. Sorry. Insert bad joke here. The Greeks are theoretical data that has to do with how an option price will move relative to the move in the corresponding stock. If I own shares of Best Buy and it goes up $1, how high up will the long call go in relation to that dollar? That's the delta. The gamma tells us how fast the delta will change, positive or negative, relative to the stock moving and getting closer to expiration. Theta has to do with decay. There's vega, there's rho, there's different ones. The Greeks are not unimportant. The Greeks are not insignificant with some strategies, but with other strategies they are. There are some strategies where the Greeks are irrelevant, and they're part of that background noise we were talking to. I would refer to them the same way as all those technical indicators, Ichimoku clouds and VW, JCP, QR. I mean, I don't want to say it's nonsense. There's probably some good mathematical formulas behind those, but in some trade strategies that you do, the Greeks are completely irrelevant. In others, they are very relevant, and I think we do a really good job at Safe Option Strategies of teaching you when and what you need to pay attention to with the Greeks versus what you don't need to pay attention to. So the Greeks are relevant in some cases, they're irrelevant in other cases. Question came in about what size of a I get this question a lot. What size of a portfolio should I have to do your program? I don't ever get to see your portfolio. It doesn't matter to me if you have $3,000 or $4,000 or $5,000, if you have $500,000. A gentleman purchased our program last week that has almost $8 million that he manages himself because he was sick of a broker. No offense, Kevin, but he was sick of a broker that was losing money for him in a big, significant way. He decided he could do it better himself, and that's great. That's fantastic. It really doesn't matter what the size of your portfolio is. I could insert another bad joke about size mattering, but I'm going to refrain. I'm going to hold off from doing that. As a general kind of a loose recommendation, I think probably you ought to have $5,000 that you could trade with above and beyond the cost of the education. I wouldn't tell you can't do the program if you had less than that, but that would be just kind of a general recommendation that I would give you. Let's see. Let me get back to where I was at. Kevin, you've had some of your clients who have additionally taken the education, and you've had some of my students and clients who have also had you trade some money for them because they want to manage a small piece of their portfolio and have you manage the bigger bulk of it. There's a question, and again, I'm paraphrasing because I don't want to read this whole question. It's kind of a lengthy question. How much help could we get with managing our portfolio as we're learning the education? Kevin, you want to answer that and tell people kind of a little bit about the relationship that you have? Kevin is not an employee of Safe Option Strategies. He works closely with us. He consults with us. But Kevin, maybe that's a better question for you to ask, or excuse me, for you to answer.
I'm going to ask it and I'll answer it. Hey, the short answer is this, guys. I think through the program, you get the ability to have some chat sessions that Jeffrey allows students to go over the trades that he's trading. There's a chat session which literally lets you go through, or I show you some of the trades that I am in, and I can answer some of the trading questions you may be in. We have a system set up for a monthly look over your shoulder program where I get to look over your shoulder, or as Jeffrey said, literally if I'm managing a portfolio for you, I try to bring them all underneath my umbrella so I can look over your shoulder to help you manage whatever else you have out there. The short answer comes down to this, and this is my opinion. If more people would take the whole education so they have all the pieces in place, they could then go through maybe just the chat sessions if they want to do it on their own. If they felt more comfortable, we have that look over your shoulder program that's available for them. And again, we also have the ability that I can literally answer live questions about positions there, and because I am licensed, bonded, and insured. So that's kind of my general thought process behind it, Jeffrey, but anything else you want to add there?
No, I think it doesn't just apply to like high net worth individuals. I mean, we do have some people that come to Safe Option Strategies once in a while that have upwards of $1 million. I know Kevin has some minimums that he'll manage to actually, be your registered investment advisor. Kevin and I have a good working relationship because there is some crossover. There are some people that really want to do this on their own and learn the right way to do it, but they want to be very cautious and maybe have, someone else managing some of it for them. So I think you did a good job of answering that question, Kevin. I don't think I need to add anything to it. It's just if you want more detail, let me answer it this way. If you want more details on that specifically, give us a call sometime in the next couple of days, and we're not going to give you any sales pitch. We're not going to give you any pressure. We'll answer your questions just as honestly and as thoroughly as we can. A gentleman typed in 2 questions. He said, is there any guarantee and is there a prorated refund? Yes to the first question, no to the second question, but I will elaborate on that. Let me explain what I mean by that. I have a money back guarantee with this program. If you purchase the program and you will complete all of the classes and trade for a period of 6 months using these methodologies, if you do not profit at least, at the very bare minimum, to the tune of what you spent on the education, I will refund it for you 100%. It is impossible for me to do a prorated refund simply because there's no way for me to know for absolute certain how much of the program you've gone through and how much you haven't. I can't, it's just not, this is purely from a business standpoint. I wouldn't even know. Everyone is different in how long they take to go through the courses. So if you had the education for 3 months and I said, well, the average is 6 months for people to get through it, so I'll give you back half your money. You may have gone through every single class in the education 7 or 8 or 10 times. And there would be no way for me to know whether that's what you did. Our website does not track how many times you view a particular class or how fast you go through the education. That's up to you. The program, I will stand behind this program and literally guarantee that if you will follow this methodology, you will make money and you will profit to at least the tune of what you spent on this education, or I will give you your money back. But prorated is just, it's too challenging with one of the reasons every single class is available online in a pre-recorded class, in addition to the live classes we're doing, is because every person I have ever met that's bought this program is probably going to go through it at a slightly different pace. And so prorating a refund just becomes an impossible thing to do. So I hope you understand. I hate giving people bad news, and I feel like I'm delivering bad news when you ask that kind of question, but that's just the reality of it. Someone has come in and asked a question. Apparently they've researched the website a little bit, and they said, what about renewal? At the end of 1 year, if you want to continue to have access to everything that is live, you do have to renew the newsletter. For existing students, a newsletter renewal is only $500 for a full year. So after 1 full year from the date you start the program, if you want to continue to have all the classes available to you live, still have them, still have your username and password available to access it on the website. The only thing you would ever have to do is renew the newsletter, and it's only $500 to renew the newsletter for an entire year. You can do it monthly, you can do it annually. There's a couple of different ways to do that. That's a great question to email us, and we can give you some more details on that. The question came in about our track record, but I think I already answered this. Maybe this person just had to step away from their computer. But let me give a little more elaborate answer. On the Signal newsletter, which is the weekly newsletter that comes out with the spread trade course, we've never made less than 20% a year in the time we've been in business and been doing that newsletter. We've made as much as 65% in a year. This is on spread trades only. Our worst year was right at 20%, and that was 2008 when the markets averaged a 40+% loss. We outperformed the market by 60% in the worst year it's had in the time that we've been in business. We have a very good track record on those newsletter trades. Collar trades are a little bit more difficult to give a precise answer on because we have some collar trades that have been open for the entire 8 years we've been in business. We have some collar trades that we open and close in a month or 2 months or 3 months. Every collar trade is different, and some of these collar trades that we've had open for a long time, we're upwards of 1,000, 1,500% profitable in some of these collar trades that we've had open. So collar trading can be very flat for a period of time when you're reinvesting your profits, and then suddenly you can see yourself 100%, 200%, 300% up in a month or two after being flat for 6 months or 9 months or 12 months or 18 months. Every collar trade is a little bit different. So if you want more details on some of the open collar trades we still have and some of the collar trades we've done, I can give you with it. I can tell you in 8 years we've never lost money on a collar trade. If you do them right, I know this is a bold statement to make. I know it's a really bold statement to make. Folks, if you do collar trades correctly, you cannot lose money on them. The SEC would just be PO'd if they heard me say that. But if you do them correctly, you can't lose money on collar trades. There's so much peace of mind, there's so much safety, there's so much security in trading collar trades. And as I've demonstrated tonight, they can be incredibly profitable. I don't know why anyone wouldn't learn how to do that. My personal portfolio, my own personal money that is in the market, and it's become a pretty significant size amount of money over the time I've been doing this program and for a few years before I started teaching it. My personal portfolio is 90% in collar trades. I spread trade with options only with the other 10% of it, and usually those spread trades are the remnants of a long put from a collar trade when the stock takes off to the upside, or a long call from part of a collar trade when the stock is taking off to the downside. Or I'll use an aggressive bull put or naked put to get into a stock that I want to collar trade. I mostly collar trade, but if you learn them both, you can use those spreads to enhance it very significantly. And look, we've got a great track record with the spread trades only. They work phenomenal. I believe I can't see that anyone is typing in anything. I believe actually, wow, that's almost uncanny. 2 people came in right at the same time with almost the same question, best number or best time to get a hold of you. The 800 or the 888, it's a toll-free number. The 888 number that should still be on your screen, write it down, 888-690-6199. I am in Mountain Standard Time. So do the math. If you have to look it up online, do the math from whatever time zone you are in. I am in Mountain Standard Time. Anytime between 8 a.m. and 5 p.m., I will probably, when I say me or somebody at the company, we have some full-time employees here, someone will probably answer that between 8 a.m. and 5 p.m. I say probably because if the phones are lit up and we're all on a phone call, you'll leave a message and we'll call you back very quickly. We return calls very promptly. If you will send an email to info, I-N-F-O, at safeoptionstrategies.com. It's been on your screen for the last 20 minutes. Info at safeoptionstrategies.com. I promise you, myself or someone else here that knows what they're doing will answer your questions. Don't let a day go by without sending us an email just saying, Jeffrey, hold that discount for me. Give me an opportunity to research what you guys are about or to get some questions answered, or give us a call between 8 a.m. and 5 p.m. Mountain Standard Time tomorrow, or the next day, whenever you need to, and just let us know. I want you to hold that discount in place for me. Give me a chance to research it, and you're either going to get an additional 25% off the full program, both courses, or an additional 20% off one or the other. But at the end of this week, folks, that discount goes away, and I can't guarantee. We do different promotions at different times of the year, but I cannot promise you that we'll do a promotion. In fact, I can tell you this with absolute certainty. September 1 of this year, our prices are going to go up. We're adding a couple of employees. We want to continue to deliver a high-quality product. The cost of the program we use to deliver these presentations has just gone up on us. The cost of some of the software we use to track what we do has gone up on us. The price of doing business goes up. We're having to pay Obamacare insurance rates for our employees now. The cost. I try to keep this program very, very affordable for people. I'm a fraction of the cost of some of the other programs that are out there. If you've looked around, if you've really done your research and looked at other education, we're a fraction of the cost of them. There's going to be a small price increase in the month of September. I promise you that. Don't delay getting your questions answered and locking in that discount if you want some time to research what we're doing. No other questions have come in. Kevin, I want to thank you again for being online with me. Kevin does this free of charge, folks. I don't pay him a penny to be here. He gives up his time to do these presentations. I appreciate it, Kevin. I can't thank you enough for being here. Folks, I'm going to sign off, and I hope you understand that if Safe Option Strategies is not the best education for you, if it's not the right fit for you, I still wish you nothing but the best in your trading. I wish you nothing but success in what you're doing. Thanks, everyone. Bye-bye.